right, let's get started. Will the Fed cause a second half slump in the stock market, right? In the economy, in the crypto market? What is the Fed going to cause? What's going to happen here, right? We're going to read this newsletter. This is the website if you want to check it out, mindgrowth.io. All right. So the latest one, we just released it. Will the Fed force a second half slump? Right? This is the good and the bad news going forward from Jackson Hole. We're going to speak about, we're going to, go over what happened at Jackson Hole, right? The Fed conference, annual conference, what's going on with technicals in the market. Okay. What's going on? Oh, forgot this light. Hold on. No wonder it looked off. And also what's going on with the economy, right? How is the economy looking, following through? So we're going to get through all this technicals, economy, Fed policy, how that affects markets in general. If you got questions, I'll stop between each segment and then we will cover your questions, your comments. I welcome you to challenge my thoughts. I could be 100% wrong, right? So let's dive into it, and I'll pull up the charts live. First things first, right? What is the bad news when it comes to the technicals, S&P 500? What is the bad news here? Well, we are looking at a head and shoulders pattern. Okay, this is a bearish head and shoulders pattern. You got your support. Basically, the current support, the break would be about 434 would be the break. Okay, and we're gonna go over the good news too, but this is the bad news, right? S&P breaking down, right? This looks very bearish. What does that signal? That maybe the buyers are giving up. There's not enough. There's a lot of shorts. There's a lot of second half weakness. It is, sell in August, sell September, right? What's going on here? If we break this support, right? If we hit the reverse head, I'm sorry, not reverse, the head and shoulders pattern, we're going lower from here, right? This could end the bull market. Not this technical pattern, but this could be the signal that the bear market is starting again, that the bull market has ended, that there's a second half slump going forward. All right, this is the bad news on a technical basis. Rate risk. This is driving the S&P lower, right? This is driving the S&P lower, which is interest rate risk. The 10 years, the benchmark rate for pretty much all rates in general, and it's breaking out, right? It is moving higher. It is in a bullish trend. It is putting pressure on the stock market. It is putting pressure on the crypto market. It is putting pressure on the mortgage, on the housing market. The higher it goes, right, the more havoc caused, the more bank collateral, banking sector collateral goes lower. So we have a problem here, rate risk, okay? And when you get rate risks, that usually leads to dollar strength. Why is that? Because as interest rates rise, right, at the Fed funds rate, well, you collect more interest on your dollar. Not only that, if there's uncertainty, people get out of their stocks, they get out of their crypto, right? Why hold risk assets if you see a black swan, right? If the mortgage market is going to fall apart, if housing is going to fall apart, if something's going to break, well, you get out of your stocks, get out of your crypto, right? Not just crypto and stocks, but your assets are at risk. So you go into dollars, right? You don't want to hold renminbi. You don't want to hold other currencies. You want to hold US dollars at the end of the day. That's why the dollar is strengthening, right? Forget BRICS. Who cares about your BRICS narrative? It doesn't matter. Most debt is denominated in dollars, and the dollar is going higher if we get a big collapse, all right? So this is the biggest macro signal to remember. This is the bad news, right? This is the big number one macro signal. Oh my goodness, I'm going to cover that up. Got in a rush there. But this is the big macro signal, 103 for me, key level for the dollar, right? This has been resistance for the last, you call it 6 years, right? 103, big resistance on the dollar. Okay. Now, when the dollar does, fall from this level, you're getting a risk on event. You got NASDAQ going higher. You got Bitcoin exploding higher. Okay. Same thing here. Dollar peaks at 103, rolls over. You got a bull market in tech. You get a bull market in crypto, right? We're here. We're here now. We're getting the dollar roll over, and you have the NASDAQ rise. You have Bitcoin and crypto rising, but we're at an inflection point. This 103 level, if the dollar keeps holding above it and starts, breaking out of the downtrend, that could cause a lot of risk. That is a big risk off signal. Okay. And when the dollar rises, stack cash. That's been the narrative, right? That's been the actual strategy there is stacking cash while the dollar rises tremendously. Okay. That's the bad news. Now let's go to the good news. Let's check out the good news. What are the good news when it comes to the technicals? Well, the S&P is still in an uptrend, right? The bull trend is still in place. S&P is still in an uptrend. All right. Number two, anchored VWAP from the banking crisis March, right? And the reason you use VWAP from there, that's when all the volume came in, right? That's when the Fed not cut rates. It's when the Fed injected liquidity. A lot of volume came into the S&P. We're at risk here, by the way, of going into the bear market. We were at risk of rolling over. And the charts are on YouTube. Got the link in the description. Charts are on YouTube if you want to check it out, or just subscribe to the newsletter. It's free. All these charts are on there also. I'm just going over it, so you can check us out on YouTube, right? So we're still in the bull market trend. Anchor VWAP from the banking crisis where all the volume came in. That's why I have anchor V. We're still holding it, right? And 431 is the big support for S&P 500, and this echoes across all the markets. S&P is, is the big. Really, the S&P 500 is the index that, if you want to know what is the global stock, what's happening with global stocks, right? What is the global stock market doing? How are equities in general? Well, this is the biggest index by far. All right. So it's holding the bull market trend. We're still there, right? Under 431. Now we got to consider that this bull market is over under 431. If we crack below that, we got to consider that. We got to say, okay, something has changed. Something is changing. We are wrong if we're bullish. And 431 is that level. All right. Now, keep in mind also, for the good news, the average trajectory following the 5 major peaks of inflation, there's 5 major peaks, but if you go all the way down, all the way back to the 12 from 1950, right? Historically, this is the return. Once you get a bottoming of CPI, once inflation peaks, right? Not the bottom of CPI, but once inflation does peak at the zero bound, this is what the S&P usually looks like. We're right on track. Okay, there's still volatility, but we're right on track. Usually that is the big signal. Once, inflation is done, you have volatility, but the S&P tends to climb higher, right? That is the history. That's the historical history. Next, good news. Flat energy prices, right? This is what gets me going at night, right? And I know people focus on core. We're going to get to Fed policy. We're going to get to Jackson Hole and what the Fed said, and we're going to translate their language in the data to understand what are we looking at here for the economy, for the stock market, okay? But 8350 year to date, right, starting in January, 8350 has been the resistance level for crude oil. Why is that important? Because crude oil, or oil in general, is the biggest input to inflation. It doesn't just have to do with energy prices. It also goes into services, because you have to use energy. It also goes into goods. It goes into a lot of things, right? Petroleum is a huge part of the economy. It's been the biggest part of the economy. That's why we have war, right? Because of the market share of oil controlling this mechanism, controlling this commodity. So it's a big deal, right? Now, what I have up here, what we're looking at is at the beginning of August, oil was at 81. Okay. Now, going back to July, we did have CPI tick higher. And that's because oil surged 17.5%. But today, looking back in August, if we stay below 81 or just, sideways, we're looking at a flat CPI. We're looking at no inflation when it comes to oil, right? All the components that go into oil, we're looking at no inflation because it's moving sideways. That signals to me, I think, right? That signals to me, in my opinion, we could see a better than expected headline inflation print. Now, everybody's expecting inflation to go higher on the headline and lower on core, right? For the first time, we're starting to get core actually go lower at a slow pace and headline move up. But I think if oil continues to drop from these levels, we could get a very good surprise upside CPI report right in September. And the market will like that. That's our upside, okay? Look at we got a lot of RSI. You have a lot of room for RSI to drop too. Now, maybe it's in a bull trend. Maybe we're going higher, but that's all I'm pointing out there. The probability looks pretty good. Excuse me. Okay, so mild, and now we're turning to the VIX here, right? Volatility index. Uncertainty is mild, okay? With all this interest rate risk, the bond yields going higher, the Fed coming out, Jackson Hole, look at the VIX. We're still between zone 1 and zone 2 of uncertainty. The higher we go, right, the higher the zone, the more uncertainty, the more likely the S&P is going to sell off, or the more likely you get a black swan event. It doesn't. This is just a predictor, right? These are market participants, right? Deciding if they need insurance against the equity market. Do they need a hedge? And right now, we're still in mild territory. There is no big risk off signal yet. Okay, we're not seeing that. What up, Ronnie? How you doing? All right, so that's what we're looking at. We're in between zone 1, zone 2. No big risks there. All right. Now, this is Tom Lee, right? Tom Lee talked about this. This was an article he wrote last week, and we are past Jackson Hole. This is about Jackson Hole, though. This is about the Fed's big annual meeting and projections. And we're not just talking about Jerome Powell here. We're talking about we're talking about multiple Fed members. And we will probably listen to what they had to say, actually, a little later on. I have a video clip of a wrap up on the headlines, right? The highlights. So over the past 2 decades, this is Tom Lee, over the past 2 decades, when stocks have seen a decline in the 2 weeks prior to Jackson Hole, which we've just seen, they've risen 6 out of 7 times, after the annual conference. So basically he's saying, 90% of the time, or most of the time, stocks actually go up after Jackson Hole. And what did we get on Friday? Right? On Friday, let's jump to the charts really quick. On Friday, we did get Jackson Hole. We had the S&P, struggle a little bit, and we got this big hammer candle. Okay. Was it crazy volume? I don't know. I don't think the volume was that great, but the volume exceeded the prior 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Count with me. 13, 14, 15. This was the biggest daily candle volume, and you could probably find a difference if you go to SPX or QQQs, but this was a reputable candle here with volume. Okay, we got a big hammer candle. So what does that kind of signal? And this is coming off of, right? This is coming off of RSI starting to bottom out here. So the oversold is, the pendulum is swinging back to the upside, right? The pendulum, we're still in the upside trend. So you got a hammer candle here. That's pretty bullish. All right, so that's Tom Lee's thoughts on it. Now we got to remember too, we're also, right, we're feeling the seasonal weakness. We're also feeling the seasonal weakness. Hey, give me a shot, or let me know if how the volume is, right? I've had some issues with the volume or with the sound, so let me know if that's solid. I can't tell when I'm live, right? Probably is a way to do it. I'm not smart enough to figure it out yet. So remember, we're still in seasonal weakness. September is seasonally the weakest month. I think we bottomed before that because it's on everybody's headlines, right? Nobody looks at this chart until you're actually into weakness, and then you start finding all these correlations, and you're like, oh my God, September is negative. So, selling should ease in September. Going into September, I think we're going to find the bottom before that, if the macro stays in line, right? If we get no surprises. Now let's head to the economy. Let's shift over to the economy. Let's shift over to the economy here. All right. Jobs are not as strong as reported. So another downward revision from the BLS. We've had a lot of the payroll reports come in, better than expected. They're still trending lower, but they've been better than expected. And we just, we're now starting to find out that over 300,000 jobs actually weren't there. So they got revised lower. So the economy is not as strong as we thought it was, right? Retail earnings reports are showing that consumers are starting to weaken. Look at Foot Locker, right? Nike sold off Foot Locker. A lot of the retail sales, they're weakening. They're reporting, they're letting us know that, hey, consumers are actually starting to weaken now going into the second half of the year. Come back to school, right? They're weakening. Some of the Fed members talked about this, right? Housing, real estate, weakness, right? This is a chart of interest rate expenses. Basically, the yield, the 30-year mortgage rates, right? How expensive it is to make your payments on your house. And what you're seeing here is the correlation is as these interest rates continue to rise, sales volume for housing is falling. All right, that makes sense. High rates, less demand, right? The higher these rates remain and sit at historical levels, right? The highest rates in 30 years or 20 years, whatever it is, real estate loans decline. You're getting weakness in the housing real estate market. Less demand, less building permits. Well, if people are not buying houses because rates are too high, there's less loans, why would home builders keep building? You're seeing the home builder permits start to flatten. Okay, maybe not in the multifamily home segment, right? Apartment rents, because rents are not as high as rents have no rates. But right now the building permits are stalled. And that's a big part of revenue and GDP, right? We did get weak So when you get the weak housing market, you also get, well, this isn't correlated 100%, but you get manufactured goods or goods demand. These are called durable good orders. They've been up, for the whole year. They've been moving higher from the whole year. They bottomed out in February and we got our first decline. So growth is stalling out, in other words, for the manufacturing goods sector. I think on the month over month it was negative. Big swings in goods. So people are changing their spending, right? The economy is recovering, but when we look at the data on a weekly basis, the reason we do this is so we know, okay, well, we don't just believe something from a month ago. We got to stay up to date with it. And it looks like those sales, our durable good orders, are down. And those are leading economic indicators for the economy. Okay. Ironically, new home sales are soaring. Now, this is counter to what we believe, that what we're looking at. This is counter to what we've saw. So year over year, right? And remember, these new home sales represent homes that are bought, or the contracts, the mortgages are passed, the contracts are signed before the house is even built. So more than likely, these are higher income individuals or who have it together, which is not most Americans, unfortunately, right? So those volumes are spiking. Those unit volumes are spiking, but the rest of the housing market, right? You're not going to get a whole lot of sales happen because nobody wants to sell their home and, buy another home for higher rates. It's just not going to happen. So a lot of the Fed members were challenged. We're going to watch the video where they are challenged on that. Okay, they are challenged on are you trying to destroy a whole generation of, the housing market? That's the question right now, because that's what you're doing, right? All that supply is stuck. It's not going anywhere. All right, now more weakness, right? For the year, this is the bad news for the economy. European, and this, we're also looking at the global economy. Economic activity in Europe is pretty poor right now. It's in recession territory. The services were leading, right? We're leading higher, and now that's not the case. They declined. They're back below the 50 level, right? These are leading economic indicators for Europe. And yes, it looks like manufacturing might be starting to turn up a little bit, right? Or bottom out, but we're still in recession territory. So Europe, they're tightening rates. They're tightening rates. And the question is, how far do they fall? And the United Kingdom and Germany and United Kingdom also, those are the biggest economies in Europe. They're also declining. You can click on that in the newsletter. What's up with China? China is not as strong as we thought either. China is also weaker than we thought. China is definitely weaker than we thought, right? They did have a surge in growth at the beginning because they came out of the lockdowns. They stimulated the market. We had global liquidity turn up, but it's not transitioning over. The youth unemployment rate, they removed it. So China is not recovering. Right now, global liquidity is low, right? What's going to happen here? Is the Fed want to, and we're going to get to the Fed, are they going to force this global recession to happen, right? Well, Atlanta Fed GDP now forecast says otherwise, right? GDP forecast, this is the good news for the economy. Atlanta Fed GDP is basically, and this is I think this is a weekly basis, on a weekly basis, and they're pointing out that growth is still rising for the economy, mostly from consumers, right? And it may not be the lower end consumer. The lower end consumer is going to struggle going in the second half, especially with student loans. But a lot of people with interest income, right? They're yielding on their cash. These are people that are higher income. They're still spending in the economy. A lot of retirees are still spending in the economy. Would you say, Ronnie, are they thinking about adopting crypto in China? Oh yeah, not as a global currency, but Hong Kong is opening up its a lot of business for crypto. Okay, so anyways, continuing, we'll get to crypto. I'll get to your questions. Jobless claims remain mild, right? So jobless claims aren't spiking either. So you got GDP revised up, right? And that's pretty quick. That's a high revision. We'll see when it slows down. And jobless claims are mild. So there's not a whole lot of, those unemployment numbers coming out this month, right? At the end of this week, actually this next week is all about employment. It's all about the jobs market, which the Fed is it going to be a key signal or key data point for the Fed to make another decision. All right, so jobless claims are mild, right? We're not seeing no big risks there for the economy, the U.S. economy. Inflation expectations are falling. You can click on this also if you want to read that. Basically, this comes down to a couple countries. I'm going to click on it really quick because this is important, right? Oil prices are a big input to inflation, which is going to impact the Fed's decision going forward. And basically, what you have here is there's more supply coming online. Iran, Iraq, Libya, Nigeria, Venezuela, I'm not going to go through all the details, are increasing their supply. and the US increasing the supply of oil, right? We're pumping oil, and yes, we should be doing more, right, to get those prices down, but we are pumping oil. And I think from here, crude oil, maybe it doesn't get past the year to date level. Okay, here's the bad news. Now we're shifting. We're going to shift over to what the Fed is saying. Okay, what the Fed is actually saying. Now I'm going to try this transition. We're going to go, what we're going to do here is actually listen to, we're going to do it. We're here on YouTube. We're actually going to watch what the Fed has to say, and then we'll go over it. I just want you guys to hear. I'm pretty sure the sound works. Hopefully this works out. I'm going to try it anyways. This was a clip I made yesterday about the Fed, basically the highlights. So we're going to listen to it, and then we'll get back to the report and go over the bad news, the hawkish and the dovish commentary coming from the Fed.
We are prepared to raise rates further if appropriate.
We are at a restrictive stance, in my view.
We're at a very restrictive stance on policy.
And intend to hold policy at a restrictive level. The process still has a long way to go.
It's not as though keeping rates where they are is doing nothing. We're actually continuing to put pressure on the economy.
On net, motor vehicle inflation has declined sharply.
How long to stay restrictive? As inflation comes down, the real interest rate,
that is the rate minus inflation.
in other words, nominal rates adjusted for inflation,
The real rate is our preferred measure.
that'll actually be tightening.
That's the way to think about how tight is the environment. And holding the rate at 5.5, 5.25, something, as inflation goes down, is implicitly tightening because the real rate will be going up.
The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through. Let us work through that. Let the banking system work through it. Let the corporations work through it. I think we just keep the pressure on and see how things turn out.
We don't see any evidence that there's a wage price.
Okay, so that's a part of the clip. It's about 5 minutes long. It's just the highlights from what they're saying about the big issues with policy, all the questions you want to be answered, right? So we're going to start with the bad news first, okay? So Powell said, these are his comments. These are some of his comments just wrapped up to simplify it. He says, after decelerating sharply over the past 18 months, the housing sector is showing signs of pickup or picking back up above trend growth. Are picking back up, and if it does get above trend growth, it could warrant a further tightening of monetary policy. So single family home prices, right, they did decline. They started declining in June. Okay, now this is disinflation, and then this was back in June of 2022. So this is when inflation peaked. This is just the price index. This is not full on inflation, but single family home prices did fall. They stayed steady for a while, and then they started moving up again. So this is just a way of, the Fed is watching those home prices, and that's a big risk to the market. That's why they might have to crash the housing market by keeping rates high, by keeping bond yields or the bond market higher than expected. And this is the bad news, right? You might get a crash there in the housing market, or, some type of black swan event. Who knows? Or maybe not. Maybe not. That's just what we're looking at here. Next. There's no clarity. So we just listened to the video, and what they were saying is a lot of the Fed members are saying we should pause here, right? We need to hold rates and just pause and see what happens, right? But what we're getting is, from Chair Powell at least, no clarity on the pause. So where is sufficiently restrictive? Where is it that policy is restrictive enough that you pause, right? And he's not giving any clarity on that. So that's negative. Real interest rates, and I'm going to define all this for you. So real interest rates are now positive, right? And with that real interest rate, and this is what this chart is right here. This is real interest rates, or, the level of restriction. Fed funds rate, you take the Fed funds rate at 5.5% and you minus PCE year over year inflation, or you could do core. It's going to look a little different. But if you do PCE, energy, and food, basically you're 2% positive, right? 2%. Rates are 2% above or in restriction versus inflation. So now for the first time since this is the first time since really 2016, 17 that we've had real rates actually positive. They've been negative for a while, which is the whole bear case against the stock market, is that we haven't had high rates for a while. That's going to hurt valuations for those stocks who don't have. Anyways, let's get back to it for the economy. So real rates are now positive. We see the current stance of policy as restrictive, right? We cannot identify. Now, this is Powell saying we do see it as restrictive. So Powell's admitting we are in restrictive zone now. Finally, we cannot identify, but here's the downside. We cannot identify with certainty where the neutral rate of interest is. Thus, there is always uncertainty about the precise level. So he's not giving clarity on where he's going to pause. Where is the best level, right, to actually pause rates? And what that signals to me is that he's saying, hey, we could break something. We're unsure. We're unsure, so we possibly could break something. Yes, we're positive now, real rates. So rates minus inflation are now positive for the first time. You're yielding more than the inflation rate year over year. But we don't know if that's good enough. We might have to, and here's another thing to think about. As inflation falls, this rate, they don't have to hike rates. As inflation falls, let's say inflation falls 1 percentage point, this rate actually goes up to 3% because it's measuring versus inflation, right? So they can be more restrictive as inflation falls without even moving the rates, which is why I think the Fed does pause here. I don't think they hike in September unless we get some crazy jobs numbers coming up. All right, because we just got the revision down on jobless, on payrolls. All right, next, negative news. This is what they're focusing. They're focused on non-housing services, non-housing services. That's what they're focused on. So now non-housing service accounts for over half of the core PC. This is Fed Chair Powell's comments, including a broad range of services such as healthcare, food, services, transportation, and other accommodations. Now, the year-on-year inflation, so 12-month inflation, in this sector has moved sideways. Translation, this is why we need higher for longer rates, because non-housing, so take out shelter, take out housing, right? Those services are still elevated. This is the 2% level right here. You can see that pretty much everything is above 2%, right? Healthcare has actually come down the most as far as services. Transportation, still pretty elevated. And this is yellow, you have, what is this, January, February, March, April. This is 3 months. From yellow to blue is the last 3 months. So they did, you're making progress here. Transportation services did come down, but they're still all highly above 2%. That is the target, right? And they're above 2%. So the one negative here, the big negative, financial services actually went up over the past 3 months. And I think this could be because of interest rates going higher. I mean, I don't know. I know that portfolio management costs actually went up. So financial services are actually inflating, right? Which is why I advocate invest for yourself. Learn how to invest for yourself, because you don't want to be paying somebody all that money to make a decision unless you can afford it, unless it's not a big deal for you. Anyways, okay. Other negative hawkish comments on policy, right? Jobs tightening. There is evidence that tightness in the labor market is no longer easing. This could also call for a monetary response. So what he was saying here is if, right, we're looking at the non-farm payrolls, you could see they've been easing all year. These are basically jobs. You could put it as jobs, but payrolls are important. This is the zero bound. We've been going lower, but if jobs start to spike, and plus we just got, some data that showed that these jobs are actually lower than expected. So I don't see this as a big risk, but let's say they do start to spike. Where would they come from? I don't know. There's a lot of people getting laid off. Then that could cause, right, the Fed to actually change their policy. So housing prices going up, jobs growth picking back up. And if payroll, so the translation here is if payroll, job growth, or job openings strengthen, we'll keep hiking. I don't see it happening. We're starting to see the economy cool here, right? Maybe consumers are spending, but a lot of the company earnings, a lot of the companies are reporting losses in their earnings, a lot of losses in consumer weakness. Okay, quantitative tightening. This is in regards to the stock market, not the economy so much. Okay, and what you got here, really, I'm just going to read it. We have substantially reduced the size of our security holdings, right? That's in red. That's their security holdings, how many treasuries they have, which is U.S. debt, and how much, corporate bonds they hold. So debt for the equity market, mortgage-backed securities, so housing market debt, right? How much they're dumping that debt. So there's debt on the market, right? We've substantially reduced the size of our security holdings, suggesting that there may be significant further drag in the pipeline. So what they're saying here is, hey, something could break because we're going to keep doing this. We're going to keep selling assets or pulling cash out of the market, which means pulling liquidity from the banking sectors, right? They don't have enough cash. So what happens if the banks don't have cash? They're not going to loan. If they don't loan, you don't really get growth in the economy. If you don't get growth in the economy, it starts to slow down. That would actually cause them to pause at some point, and I think they're looking for that. Where's the reason to pause. Also, you have cash leaving the market here, the money market funds. This is a little more technical, but this cash has been rising. This is one of the big reasons the stock market actually bottomed in January, because you had money market fund cash leaving in January. It left and went into equities. Well, we don't know that exactly, but the correlation is pretty sound. Cash left the Fed that was collecting interest, and it came down a little bit and it went into the equity market, probably chasing AI plays, right, into the future. But now that cash is stalled, so now you're getting the bank, you're getting central bank or the Fed selling their assets. They continue to shave the balance sheet off or pull cash out of the system. And if this money market fund cash, which I like to call it, comes out of the system also, you're getting a real drain in liquidity, and equity markets don't like that. Now, here's the good news. We're going to shift over to the good news if we have no other comments. Yeah, let's shift over to the good news. So the good news on the Fed, dovish commentary, right? I think it was a better report than people give it credit for. They did come off hawkish at the beginning, but I think it was not too bad. So labor market normalization. Okay, labor market supply, so people coming into the workforce, has improved, driven by stronger participation. Demand for labor has moderated as well, so companies don't need to increase wages to get people to come in. Job openings remain high, but are trending lower. That's what they want to see, trending lower job openings. Payroll, meaning that companies are closing their openings, so they don't have to raise their wages. Payroll job growth has slowed significantly. Okay, so payroll job growth, and that's the payrolls that we were looking at earlier. Total hours worked has been flat over the past 6 months. On the average the average work week has declined also to the lower end of its pandemic range. This is what they wanted to see. They want to see the labor market cool off or come into balance, right? Reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Translation, the labor market is coming into balance. And this chart exemplifies that pretty clearly. I want to simplify this for you guys. Labor force participation in yellow, right? That is how many people are coming into the labor force. You want that up. And I think there was a record for female or women coming into the workforce. That number was at a record high. So you have people coming into the workforce, which you want to happen, right? Pandemic highs were back here. And at the same time, the employment cost index in red, so how much it costs a company to pay for employment or their servicing costs for their business, whatever you want to call it, that's also falling. So this is a precursor or reflection of wage prices, wage price spiral, right? You hear wage inflation. If this comes down, you're not getting wage inflation because companies don't have to compete for wages. They don't have to raise their wages to get people to come into work. They are now coming in, and those wage costs are falling. That's good for the economy. That's what the Fed wants to see to ease policy, or at least to change their language, okay? Next positive on policy. Next, dovish, I like to call it the dovish, if you're familiar, dovish comments from the Fed. Core goods inflation has fallen sharply. Motor vehicle, and he talked about motor vehicle inflation has declined sharply. He said that, he talked about that twice. And when we look at PCE, this is the measurement from the Fed when they say 2%. We're looking at PCE here. This is the 2% bound, basically, right? And what they want is everything below that or near it. So we are seeing goods, durable goods and non-durable goods in negative territory for this past month. We do get another report Friday. So Friday is another big day, which would be, what is Friday? Friday is going to be, Friday is going to be the end of August, September. So basically looking into Friday, we're going to get another report. Now your headline PCE, we're going to go over this a little later. Basically, we're focused on goods and durable goods. Motor vehicle inflation all coming down. It's in negative territory. So we're getting positive. And this is disinflation. I know people say, oh my God, inflation is still high. Well, disinflation, it's coming down from its previous, inflation is the rate of change. It was at 9% and it's coming down. It's still going up. Prices are still rising, but at a slower pace. And think about on the flip side, if you own the inflation, if you run a business, you don't necessarily want inflation to go to zero. That means you're not going to be able, you're going to have to lower your prices. You earn less, right? So it's a balancing act. Okay. Next positive. This was a big one. I think this is going to determine the end of the hiking cycle here when we get to this point. Okay. Now let me just go over his comments. Because leases turn over slowly, it takes time for a decline in the market for rent growth to work its way through to overall inflation measures, meaning, well, we'll get to the meaning. The slowing growth in rents for new leases over roughly the past year can be thought of it as in the pipeline. When he says in the pipeline, it means that this blue level, which is rent growth CPI, right, 7.9%, that's very elevated, that it's in the pipeline, meaning it's going to convert into the red line. Eventually, it's going to find its way lower. It peaked, this is Zillow observable real-time rents. And Powell did say in his speech, we do look at real-time rents from Zillow, from Redfin data. He talked about real-time rents actually much lower than the CPI is showing. And they want to see more progress on that, which is another reason why I think they pause here in September unless we see a surprise. So rent inflation is rolling over, observed by the real-time rents, I like to call it. And eventually we are starting to see the rollover in the PCE, which is their inflation gauge for housing prices, right? Or housing in general. There's all these little technical terms. For the most part, you want to see that come down. It's a big component of inflation, and that would get them to actually. Now, what you do need is more supply in the mortgage market, right? You need home builders to keep building, not just multifamilies. And that's why I think rents come down faster, because there's a lot of construction builds for multifamily homes, apartments, but not so much for single family homes. And that means rent prices will be much lower than actual shelter, than going and buying a mortgage because rates are too high. You get a shift, a global shift or a secular shift into renting versus owning a home because of that. That's going to be interesting. We'll keep track on that. Okay. So the real question here for me, or for everybody, why we're on here, VIX is about to rip higher and crush the market. Maybe so, but the VIX actually isn't responding. You can check out the beginning of this video. We'll go over the VIX. The VIX isn't really doing anything after the meeting. The VIX actually is moving lower. It's in zone 2. Once it gets above 20, then yeah, we're like, okay, we got a problem. But so far the VIX is not there. Now, if you're just forecasting it gets there, okay, why do you think the VIX goes higher? That's a fair assessment. There's a lot of reasons it could. What is your main reason why the VIX goes higher and crushes the market? Let me know what you think, Latchman. COVID. Okay. The new COVID strain, I don't know. Is that real? Do you think that the market really cares about that? Is it really a surprise? If it's already in the news cycle, the market's already priced it in, right? The market would really be getting crushed right now. I'm pretty sure that you are not the first person to find this COVID strain out. Now, if it gets worse, if we get a surprise, we might be in trouble here. But then you better own some Zoom stock, right? Better own some Zoom stock. So when will the Fed end the hiking cycle? Well, I just have here, this is the 2% target. This is what they're focused on when it comes to their inflation gauge, which is PCE. You don't really need to know the details of that, but year over year PCE, and then you have core. And right now, goods, durable goods, non-durable goods are in that zone. You got healthcare nearing that zone, but these are the two figures here. PCE is at 2.9%, okay, year on year. I think we get down to 2% faster than people might expect. Maybe I think the market still rallies to all-time highs. We're holding the zone. We talked about the technicals earlier, the bull case and the bear case, and we need PCE to come down. You need core PCE to come down. Core PCE is still pretty elevated, at least 3.5. You need to get down. We need to get that down. A lot of this is rent though, okay, and other services. So we'll see how that plays itself out. Now here's the optimistic view, right? The optimism. Global rates are starting to shift. So if we look at the whole percentage of all central banks in the world whose last move was a rate cut, you're getting that shift up. You're getting this is a measurement of all central banks, and you're starting to get the cycle turn back up, meaning rate cuts are starting to proliferate. I can't even say it, across the global economy. I think it was like Brazil. I don't have exactly who it was, but 27% of the world central banks are starting to cut rates now because inflation is falling like a rock, despite what people think, on a year-over-year basis. Okay, it is falling like a rock on a year-over-year basis. It doesn't mean your prices are falling. It means the rate of change is coming down. Disinflation is happening in China. Inflation is zero, by the way. There is no inflation in China. Prices are actually falling, which also correlates with their economy weaker than expected because, prices are falling. There's not a whole lot of demand. Stop, decline, not trying to do that. All rates are biting. Yeah, rates are starting to bite 100%. So yeah, if you want to check any further, go check out the newsletter. Link is in the description, link is in the bio. Before we end there, I'm going to switch over to the technicals really quick. I do want to point out, a couple trades that I see developing if the market does hold up. So if we do get the S&P, here's the S&P coming off a low RSI. Let me make this bigger so we can see. There we go. Which one's better? This one. All right. So the S&P, and if you want to see the technicals, just jump over to YouTube. Got them on there. All right. So this is S&P. Like, yeah, we got yes, you are looking at a head and shoulders, right? Here's your head and shoulders here. I see it. Okay. Boom, head and shoulders. Okay. But we had a nice bounce with really good volume, right? That's really positive volume that we got on Friday following a big meeting, following an inflection point. So you got support at 438. The 438 level we held above, which was my big level. Okay, the bottom is 435. So whatever you want to put it, but we're above that level now. Okay, and if we can't get past 444, in my view, the previous high, then yes, we're looking at a rollover, a consolidation. But we can only speculate on this. We're still holding the bull market trend. Okay, we're still holding the bull market trend. We're still holding anchored VWAP. So institutions are still bullish. That's what that kind of signals there. And if we look at the moving averages on the daily chart, yes, we dropped the 50-day. We got rejected by it, but we're still holding the 100 daily moving average. So 431 is our big support level. Okay, 431 is still our giant support. Now the actual thing I wanted to signal here is Tesla. Tesla is setting up. Also, if you're secularly looking at Bitcoin, or should I buy Bitcoin? 25K is a good place to start dipping your toes in. 25K is the big level for Bitcoin. Doesn't mean it's going higher, but as a risk reward, you want to start dipping your toes in. If you're not in at all, it is a big level to bet on. Okay, you never know with regulation. And it's a level to bet on given the backdrop that the Fed is going to have to reverse course at some point. Could it drop lower? 100%. You could wait it out, but at least dip your toes in, get used to the price action, fill it out. So switching over to Tesla, though, this is bullish. This is more for this bigger swing traders, right? If you're looking to swing trade, I'm looking at Tesla here. Yes, Tesla's below the 50-day on the 100. Now, here's my thesis for Tesla, okay? What is this? This is the log chart. We'll go to the regular chart. I do the log chart typically, but if you go to the regular chart, non-log, okay, so removing this one, we're holding the uptrend. Tesla is holding the uptrend. All right. So Tesla's holding the uptrend. It's literally once you touch that trend, that's where you go bullish. Let me just go to the log so I can do this a little quicker. So once you get to the uptrend, right? I'm sorry, not get to the uptrend. Once you get to the support of the trend, that's an entry point, or that's a decision to make. That is a place that you can think of, okay, if it holds here, well, this is pretty much a very good entry point. We're holding above VWAP also, okay, anchored VWAP, which comes from the lows. So we're looking at the lows. If you want to change it to where all the volume came in right here on that first earnings report, right, you could change it here. It's the same thing. We're still holding. Oh, that was the wrong one. We're still holding. Anchor VWAP is still holding. Okay, actually it bounced off the anchor VWAP at around 212. So you do have a lot of support here for Tesla on this trend. Yeah, this is the one I was looking at. Okay, there we go. So Tesla is holding the uptrend. Okay, RSI. I'm messing this up. RSI is also got to that oversold area. So this is a big signal too. I really like to swing trade off RSI. RSI went oversold, right? So that's a big signal. Typically, for the most part, your probability is much higher that it bounces. Now we're looking at, okay, it is going to bounce. It is bouncing. As a matter of fact, we're getting the bounce. Can it hold? Two factors. Does the S&P hold? Do the Qs hold? Well, so far they are. We had a bullish signal coming from Friday, right? Following the Fed symposium. And we did break the trend. Tesla broke the downtrend in the short term. Okay, it is starting to wedge here. So could we retest VWAP? Yes, but you have more support. If it retests, well, that's even more. That's more reasons to actually. Oh wait, here's our resistance. Our resistance is 441. We need to get above 241. But if we do come back and retest, you're just looking for another bounce there. Okay, so there's a lot of support there for Tesla in the uptrend and the overall market, and there's a lot of catalysts in the pipeline also for Tesla to go higher. So those are the technicals. You turn on the simple moving averages. It's holding the 100 simple moving average. It's holding that anchored VWAP level. Volume isn't great yet, but it is touching the trend. It is touching the trend, and you're looking for the overall market. It is breaking the downtrend. Typically, you do get a retracement of about 25%. You got it here, 25.6% bounced. Here, you got 26% bounced. This time, we're getting 29, I believe. Yeah, about 29%, 28%, and we did bounce. So it could just hug this trend a little further, right? The more it consolidates, the more bullish. But you're looking for the break above. The confirmation is above 240. That's the confirmation. So maybe you dip your toes in and then you get in a little further. Either way, that's what I'm looking at. That's the information I have for today. If you guys have any questions, let me know. If not, I'll finish up here. Any thoughts? Let me see. The dollar. I know somebody said something about the dollar is not rolling over. The dollar is a big risk here. Oil's coming down. I think that's positive for the market so far. If I did not miss, if you guys had any comments, let me know. I think, oh, fear and greed just touched fear. Yeah, that's good. That's also positive for the market. If you're getting super fearful, then plus all the rate hikes, then people are, the more fear, the better if it doesn't play itself out. That's where the opportunity is, right? The opportunity in the market is typically, I'm just going to talk a little bit. The opportunity in the market is typically when everybody's, looking one way, when everybody's expecting something negative to happen, they're not positioned, so they're under positioned, they're underweight. They sold this whole rally because, all the interest rates are rising, the Fed hiking rates, recession fears, the Magnificent Seven are up too much, you got to sell them. They're not anymore. Tesla's pulling back a lot, and AI is not a real theme. So people might be under position now. Now, we're just saying probabilistically wise, right? What you really do need is the Fed to not hike again. If they do hike September, the market has to price that in. The dollar probably goes higher. You get the market pull back and test 431, possibly rolls over if you get other banking crisis risks. If global liquidity doesn't pick up, you're going to have an issue. Okay, China is not printing. We need China to come back and start printing, which I think they do, because typically when economies go into recession or they're heading into a recession, then central banks start printing again. The government has to lower rates, and we saw China lower rates twice already. So they've already lowered rates twice. Now you're looking to Japan. Is Japan going to do yield curve control? What that means is they start stimulating, they increase liquidity in their markets. They start buying their treasuries to lower the rate of interest on their bonds, right? Is the U.S. going to do that in some form or another? We don't know. So really the biggest risks here are, U.S. treasuries are the debt system that run, pretty much you price everything off treasuries. The higher that treasuries go, you know what? I missed the bond market. We didn't even go over the bond market. Right now, the bond market is bouncing, very bullish divergence. So if bonds keep moving higher, rates come down. If they have peaked, then liquidity comes back in because you lend based off treasuries, the yields on treasuries. As long as that collateral is not at risk, liquidity should come back in the markets. Now, who benefits most in this environment? Let's say that growth slows back down. The Fed actually does stay on pause. Okay, let's say the Fed pauses and growth slows here. Well, if interest rates remain elevated, then most of these companies, this is fundamentals, we're shifting to fundamentals here, companies who are just not earning a profit yet, they're going to be in trouble. You want to stick with companies who are actually earning a profit. Not only are they growing revenue, but they have earnings. They have earnings. They're not super sensitive to interest rates. Most people are. Most companies are, but they're not in trouble from a financial. Their balance sheet is strong, right? They don't have more debt than assets. There's a lot of signals that you look at. So unprofitable companies are going to be at risk with a high interest rate environment and growth slowing. They don't have a lot of profit already. One of my favorite things to think about is Tesla. They're gaining market share. Their revenue growth is insane. They're the best-selling car in California. They're the best-selling car Model 3 in the world. So their growth is actually expanding. You're going to get some bears, but Tesla's doing well. Apple's going to do good, right? They're going to do well. People are buying their debt. What up, DigBT7? What up, G? I don't even know. Who are you? Oh, Twitter. Oh, what up? Okay. Or not Twitter. That's the first time I've seen somebody on Twitch. I hope everything's doing well. Anyways, Let me know who you are and send me a message. This is, I don't know what I haven't seen nobody on Twitch actually come on here, so that's kind of interesting. Anyways, going back to the market. So who's going to survive here? Probably companies who have pricing power, right? They can increase their prices a little bit. Chipotle, whoever it is, consumers keep spending. They're still profitable, right? They're positive. Their earnings are positive. Um, Palantir is a big AI company who is doing pretty well. They are now cash flow positive. Not cash flow positive, I'm sorry. They're now positive in their earnings. So they're, for the first time, they're profitable, okay? Meaning all the revenue they bring in, they're actually turning a profit with that revenue. Their margins should be expanding going forward. And at the same time, the demand for AI is very strong. We saw NVIDIA, right? Chips for AI chips growth is in demand for a reason. And looking at AI plays, there's so many of them. There's a lot of false signals there, but I think Tesla has the best AI also, right? It has a robot that actually drives itself. So full self driving, that's something to look out for. Full self driving. Um, Not that it's coming fully, but when it comes to price growth, just the regulators confirming that it's actually something that can work, and regulation being passed, more progress. Elon making a deal with some other OEM company for full self drive. I don't know. I just think there's going to be a lot of FOMO if if we don't see the risks come on. So the Fed does need a pause in the macro. The economy needs to stay cool. Maybe not, super. The economy doesn't need to go up much faster because the Fed could definitely respond to that or have some negative commentary. The bond market goes up and tightens the market for itself. But if the economy slowly trickles lower, that might not be great for consumers, right? Or not consumers, that might not be great for jobs and all that, but it actually is better for the stock market because that means the Fed can stop hiking rates because the economy is total spending. The stock market is asset appreciation. So it's going to look way further out than the economy. The economy is what's happening now. The stock market is what it looks like in 12 months, right? 12 to 18 months. It looks much further out ahead, which is why prices start to climb. Back in October, they started to climb a lot faster than the actual economy actually recovered because stocks they're forward looking. All right. So, I mean, that's all the content I have for now. We'll stay up to date with things. Check out the newsletter if you haven't already. And we'll be back on Monday trying to get the schedule together. I don't know what people like. Do they want to see early morning price action? Do you want to see, I'm not going to be trading live because there's too many other things I'm taking care of. But we will be tracking the market. I'll give you the best macro news. What is going to determine what's happening next, right? So keep your eye on that. I think the market can bounce here because we're seeing the technical support that. And maybe the Fed does pause. Our next going forward, so this is for next week, it's all about jobs, right? Next week are all about the jobs reports. Look out for oil prices staying tame. We want tamed oil prices. Want them to stay where they're at. Nothing above 83.50. That's positive. And for the calendar, again, looking forward to next week, it's all about jobs. And then we have the PMI data. So we're going to see if PMIs are stronger or weaker. If they are weaker, then that's going to give a reason for the Fed to actually pause also. And then we have PCE data on, is this Friday? Okay, Wednesday. Nice. We got PCE data on Wednesday. We got job openings on Tuesday. Try to look through this data really quick. Yeah, so personal income. So we're going to see where the consumer is at on Wednesday as far as spending and income. If it does decline, we should get a pause, or that's going to put that's going to add one variable to the pause or to the stopping of rate hikes. They could hike later into the year, but I think they stop at this point to wait and see, right? Core PCE Monday, we get that also. Get some more Fed speak, jobless claims, China's manufacturing index on Wednesday also to see if they're falling further. Unemployment on Friday. So Friday, September 1st is going to be the big report that the market is going to trade off technicals this next week. And it's either going to price in worse numbers or better numbers. It's all psychology here, which means if you see the market start to bid higher, it's going to expect that those numbers are not that hot. But if the numbers are hot, it could actually sell off into Thursday and then recheck what does Friday's numbers actually look like. There is no direction. There's no clear direction. You just want to see, are the buyers going to step in at the big 431 level for the S&P, or does it roll over going forward? And I think that's it. Yeah, I think that's all we have. We just have big jobs report. We don't have inflation expectations at all. Watch for the dollar. That's the big macro signal. The dollar keeps breaking out. It's going to be really tough for stocks to stay, and crypto to really hold the level if the dollar starts to break out. That's going to push down assets in general. Anyways, I appreciate you guys jumping on. You guys stay blessed. Have a good weekend. And I'll check you guys later. Check out the Fed policy video on my YouTube. If you don't mind, go like, subscribe over there. Help me out a little bit with the algorithm. I'd appreciate it. I appreciate you guys just jumping in. All right, we'll catch you next time. Thank you again.